Okay, welcome to this part two of Module 8. We're looking at price ladder setups for data point trading. Specifically, what we're going to be going through now is to determine, or how to determine rather, uh, the importance of the news slash data point and the effect in the market on the market. So, what we want to cover now is basically look at how are these data points affecting the market and in which ways. So the very first thing we want to look at specifically is volume. And this is, as we said before, this is an order flow course. We're going through price action. So the most important thing to understand is the volume. Is this figure doing volume? So we want to know, is the figure doing volume? So am I trading, for example, some obscure figure that no one ever looks at, the Case-Shiller House Index, which it does get, sent over the squawk. They put it in the economic calendars, but there's no volume. Why would I trade that figure? As opposed to a figure that's really relevant, inflation or employment. Those figures are doing volume. Has the volume been increasing over the last? So again, another question. If so, and if you're seeing a notable change in the volume from the rest of the day, if so, has the volume been increasing or decreasing? And that's a very simple indication if the market's paying attention to it. If there's no volume, if the volume's getting higher and higher each time, that means the market's paying more and more attention to it. Especially if the figures are starting to get a little bit more volatile, and especially if the central banks are looking at it, which we'll look at in a second. Then we want to start asking ourselves, okay, well, we know we've seen that there's volume on this figure. We've seen that it's increasing, and we know that we want to trade this now because there's potentially opportunity. What we want to know now, the average tick range for the figure. And this doesn't have to be so precise, but just do a quick analysis. I mean, if you really want to be precise about it, you can actually look back all the figures, um, look at the frequency of it moving 10, 20, 30 ticks, or, you could do a little bit more granular, but 10 and 15, 15 and 20 ticks, and look what the frequency is. If we're doing the most frequency of times, every time this figure comes out, we're seeing a 30 tick move. I know that at 30 ticks, if the markets move that much on that figure in that hour or in that 2 hour period, I'm looking to get out of the market somewhere there. So just have an idea what's the average tick move on the figure. Do short analysis, do a short analysis. You can quickly back test this. Just look up on you don't have to do anything crazy. You don't have to program anything to do that. Just look on a chart, really, and you can get that sorted pretty much. The next thing you want to look at, which is probably a very important thing to look at in terms of understanding the sentiment and what markets it's affecting. So that's really what we want to start looking at now, is how do different asset classes react? And, we can very simply just draw ourselves, we can say, okay, well, let's just look at some various asset classes. We're going to look at FX. We're going to look at the bonds. We're going to look at equities. We're going to look at commodities. And in doing so, we can quickly just sum up more or less how each of these is going to react. And you can obviously be a bit more specific with FX. They're pairs, so you're going to have to do it more on each of the individual currencies. So you'll do something like, okay, well, I know that on a high employment figure out of the US, let's say the non-farm payrolls, which is a very popular figure that everyone knows, on a very high number, I should see the US dollar go up, for example. On a low number, conversely, it should go down. So then you start looking, what's the US dollar doing? What's the euro going to do? What's the Aussie dollar going to do on this figure? What do you think how it might react? Um, you start looking at any of the other currencies, really, the yen, for example, the JPY. What are these currencies doing on each of these figures? We're seeing let's say if we get a big rally in the dollar, is that affecting risk assets? Are we seeing a risk off move? If so, then maybe the yen might go up. So you start looking at these correlations. So you start building a reaction function. What am I expecting on the figure? So I can actually, when it actually comes out, I'm not surprised by anything. Or if something acts differently, then I know something's changing. Maybe I shouldn't be as aggressive. But if everything's acting the way I expect it, maybe I'll go a little bit harder and push my size a bit. So these are the kind of things you look at. So for example, you look at US bonds, then you look at German bonds, you look at UK bonds, how are they going to be affected? On equities, what's the S&P 500 going to, how is that S&P 500 going to react? Not the S&P 5000, sorry. So S&P 500. What's the FTSE going to do? FTSE 100, DAX, Euro Stocks 50. Generally these are all going to be very correlated. So on a better than expected number, are the equities going to rally? Well, let's see. If there wasn't the concern of a rate hike, for example, in the current environment, when I'm currently now speaking and recording this course, well, probably they'd all rally. They'd all just rally because better employment means a stronger economy. But possibly if we get concerns of a rate hike, then maybe in that scenario, we'd see the S&P underperform, and maybe the European equities will actually outperform the U.S. equities. These are the kind of case scenarios that you could start building, start imagining in your head. In the commodity space, what's oil going to do? Well, if the dollar rallies, maybe the oil might go down. What's gold going to do? Again, if a dollar rallies, we might see gold go down as well. What's copper going to be up to? Because Dr. Copper is a very big indicator of how the global economy is doing and how China is doing in particular. Looking at the metals, oil, natural gas, take a look at the commodities. What are you expecting from them? So when the figure comes out, you can now have a reaction function spectrum in your head. You start saying, okay, well, I'm expecting the dollar to go up because we've just had a big number. I'm expecting the bonds to go down on that sort of figure because potentially we've got the rate hike implications. So once you have these scenarios in your head, you can start building a plan of how you want to actually start trading the figures. And then it's not just how they move initially. Then you start asking your questions, you start asking specific questions about each asset class, like, are we getting knee-jerk reactions? So for example, in the equities, if let's say we have that concern of a rate hike, and you have the market, we get the announcement that the NFP comes in or the job number comes in higher than expected. First you get the knee-jerk reaction up because that's better for the economy, and then people start selling into it, and you get the move down. And this is technically our starting price right there. You get the move up. People think, oh, that's good for the economy. Then the smart investor comes in and says, I'm going to sell this, and you get the move down. Are we getting knee-jerk reactions? Again, it's part of your plan, what are you expecting? And obviously this you build with instinct. In the beginning, when you're a beginner, you're novice at trading, you want to probably write all of these things out, understand where they're all going to move. If you're a more seasoned professional trader and you're listening to this, I'm sure you already know some of these reactions, but it's always good to look back and see what they've done just so you get a better picture. And then obviously the most important thing, I think, in terms of event trading is actually understanding which market will give me the biggest bang for buck. And that, guys, is just the essence of doing your preparation. Because if you can understand now, you've looked at all the markets, you've seen, you've started giving yourself a reaction function, and you know what should happen. Well, if you look back and you say, you know what, on this figure, the dollar seems to move a lot more than all of the other ones, doesn't have a knee-jerk reaction. I can hit it on the figure and get on side quicker with more size. Why would you trade any other product? Why would you trade a product like the S&P, for example, when you're getting these gray area moves where you don't actually know whether it's going to go up or down? You don't want to be trading the markets that have a gray area reaction function. You want a reaction function that's very clear cut. So, for example, in the US bond space, if you're trading, you know, a, a much better than expected figure that has the implications of a rate hike, well, we might start seeing a bit of curve, uh, yield curve flattening, which means the longer end of the curve, so the 10s and the 30 years might start outperforming the shorter end of the curve. So do you really want to be hitting short? Because we know that the bond should go down. Do you want to be hitting short on the longer end or the shorter end? Well, the shorter end is a better bet. So I'll actually put my my chips on the shorter end of the curve. I'll hit more size on the shorter end of the curve than the longer end of the curve. This is what we mean by building a robust plan for trading these figures. Um, and for now, we're going to end this video around just determining the importance of the figure. And in the next video, we're going to actually look at the importance of understanding the structure of the market going into the figure, which is of utmost importance. So thank you for listening and stay tuned, guys.